Good morning to all. I am Dr.R.LATHA, Assistant Professor, Department of Commerce, A.D.M. College for Women, Nagapattinam. Today's topic is Introduction of Banking. The second BCom students, Introduction to Banking, course content, what is banking, meaning and the definition, role of banks in economic development, types of banks, commercial banks, functions of commercial banks, central banks, functions of central banks, RBI norms for banks. Next one, banking theory, law and practices are essential aspects of the banking industry that govern the operation, regulation and management of banks. Banking theory refers to the principles that underpin the functioning of banks and the financial system. Banking theory is built upon economic theories that help to understand the dynamic and the complexity of the banking sector. The banking law comprises the legal framework and regulations that govern the establishment, operation and the supervision of banks and financial institutions. And the banking practice refers to the day-to-day operational activities and the procedure banks follow to provide financial services to customers. It includes various banking functions such as accepting deposits, granting loans and credit, facilitating payments and transfers, managing investments and offering other financial products and services. Now let us see the meaning and the definition of banking and its role in economic development. Banking refers to the business activity of providing financial services and products to individuals, business and other entities. It plays a crucial role in the economy by facilitating the flow of funds, providing a safe place for depositing money, offering credit and loans, and performing various financial transactions. The main purpose is to give security and confidence to the economy and operates in line with managing the flow of money between people and business. Let us see now the basic primary functions of a bank. It accepts withdrawal and deposits, it provides loans, opening different types of accounts, providing internet banking facilities, providing customer support facilities, issuing credit and debit card, remittance of funds and bills payments. Next, let us see now what is the role of banks in economic development. Banks play a crucial role in the economic development of the country. First one, to mobilize savings. Banks encourage individuals and business to save money by offering attractive interest rates and safe storage of funds. By mobilizing savings, banks accumulate resources that can be used for investment economic development. These savings are channeled into productive sectors such as infrastructure projects, business and entrepreneurship, fostering economic growth. Credit provision. Banks provide loans and credit facilities to individuals, business and governments. This credit enables business to invest in expansion, research and development, increasing production, job creation and overall economic growth. It also provides loans for housing, education and other personal needs, improving living standards and human capital. Next one, financial intermediation. Banks act as intermediaries between savers and borrowers. They collect deposits from savers and lend these funds to borrowers, facilitating the efficient allocation of capital in the economy. This intermediation process helps to bridge the gap between those with surplus funds and those in need of funds. Next one, payments and settlement services. Banks provide a reliable and efficient payment system that facilitate domestic and international transactions. This allows individuals and business to engage in trade, commerce and financial transactions smoothly, contributing to economic activities and growth. Next one, risk management. Banks play a crucial role in managing financial risk. They assess the credit worthiness of borrowers, conduct due diligence and undertake risk management practice to ensure that loans and investment are made prudently. By managing risk, banks contribute to financial stability, investor confidence, and the overall health of the economy. Next one, financial advice and services. Banks offer financial advisory services to individuals and business, assisting them in making informed investment and financial decisions. They provide expertise in wealth management, retirement planning, investment opportunities, and risk mitigation strategies. This guidance helps individuals and business to optimize their financial resources and contribute to their long-term economic well-being. Next one, promoting financial inclusion. Banks play a vital role in promoting financial inclusion by extending banking services to underserved and unbanked populations. They facilitate access to essential financial products and services such as savings accounts, credit facilities, and insurance to individuals and business previously excluded from the formal financial system. This inclusion helps to reduce poverty, improve livelihoods, and empower marginalized communities. Next one, economic stability. Banks under the supervision of central banks contribute to overall economic stability to implement monetary policies, manage interest rates, and regulate the financial system to control inflation, stabilize currency values, and promote sustainable economic growth. Discuss about the types of banking. There are several types of banks, each serving specific functions and catering to different customer segments. Are some of the common type of banks: commercial banks, retail banks, corporate banks, investment banks, private banks, cooperative banks, development banks, central banks, and online banks. First one, commercial banks. The commercial banks are the most familiar type of banks. They offer various services to individuals, business, and organizations. These services include accepting deposits, providing loans and credit, facilitating payments and transfers, issuing credit card, and offering other financial products and services. Second one, retail banks. Retail banks primarily focus on serving individual customers, offering services such as savings accounts, checking accounts, personal loans, mortgages, credit card, and other consumer-oriented financial products. They have branch networks and online platforms to cater to retail customer banking needs. Third one, corporate banks. Corporate banks provide banking services to large corporations, multinational companies, and institutional clients. They offer services such as corporate lending, trade finance, treasury management, foreign exchange, and advisory services for merger and acquisitions. Next one, investment banks. Investment banks specialize in providing financial services to corporations, governments, and high net worth individuals. Their services include underwriting and issuing securities, facilitating mergers and acquisitions, assisting with capital raising, conducting research and analysis, and providing advisory services for complex financial transactions. Next one, private banks. Private banks offer personalized banking and wealth management services to high net worth individuals and families. They provide tailored investment solutions, estate planning, tax advisory, and other specialized services to meet the unique financial needs of their wealthy clients. Next one, cooperative bank. The cooperative banks are owned and operated by their members, typically individuals or organizations within a specific community or profession. These banks are focused on serving their members' financial needs such as providing savings and credit facilities, particularly in rural areas or specific sectors. Next one, development banks. The development banks are established by governments, or international organizations to promote economic development. They provide long-term financing for infrastructure projects, small and medium-sized enterprises and other sectors crucial for economic growth. The development banks often prioritize lending to sectors and regions that may have limited access to financing from commercial banks. Next one, central banks. The central banks are the monetary authorities of a country and are responsible for formulating and implementing monetary policy. They regulate and supervise commercial banks, manage the country currency and foreign reserves, and maintain financial stability. Next one, online bank or internet banks. Internet banks, also referred to as online banks or virtual bank, operate exclusively through online platforms without physical branches. They offer various banking services including online account, opening, digital payments, remote customer support, and other digital banking features. Internet banks are known for their convenience, accessibility, and often competitive interest rates. It is important to note that the availability and naming of different types of banks can vary across countries, and some banks may offer a combination of services from multiple categories. Next topic, commercial bank. Now let us discuss in detail commercial and central banks. Commercial bank. Commercial banks are the most familiar type of banks. They offer various services to individuals, business, and organization. These services include accepting deposits, providing loans and credit, facilitating payments and transfers, issuing credit cards, and offering other financial products and services. The main purpose of commercial banks is to provide financial services to the general public and also provide loan facilities to business, which helps to ensuring economic stability and the growth of the economy. Therefore, credit creation of the most important purpose of commercial banks. Bank of Calcutta is the oldest commercial bank in India. It was established in the year 1806. It was later renamed the Bank of Bengal. Currently, it is known as the State Bank of India. Functions of commercial bank. Let us see the functions of commercial banks. Accepting deposits. Commercial banks are a safe place for individuals, business, and organizations to deposit their money. They accept various types of deposits including current accounts, savings accounts, fixed deposits, and recurring deposits. By accepting deposits, commercial banks provide a secure place for people to store their funds while earning interest on their balances. The providing loans and credit. One of the primary functions of commercial banks is to provide loans and credit to individuals, business, and governments. They assess the credit worthiness of borrowers and extend various types of loans such as personal loans, home loans, auto loans, business loans, and working capital financing. By providing credit, commercial banks stimulate economic growth, support investment, and meet the financial needs of borrowers. Next one, offering payment services. The commercial banks facilitate funds transfer between individuals, business, and organizations. They offer services such as check clearance, electronic fund transfer, issuing debit and credit card, and providing online and mobile banking platforms. These services enable customers to make payments, transfer funds, and conduct financial transactions conveniently and securely. Next, acting as a custodian and a safekeeper. Commercial banks act as custodians and a safekeeper of valuable assets and documents. They provide safe deposit boxes to individuals and business for storing valuable items, important documents, and securities. Banks also offer custody services for holding securities and other financial assets on behalf of clients. Next, foreign exchange services. The commercial banks facilitate foreign exchange transactions and provide services related to foreign currency exchange. The help of individuals and business convert one currency into another, conduct foreign currency transactions and manage foreign exchange risk. Commercial banks also offer services such as foreign currency accounts and international payment solutions to facilitate international trade and cross-border transactions. Next one, investment and wealth management. The many commercial banks offer investment and wealth management services. They provide investment advisory services, manage investment portfolio on behalf of clients, offer mutual funds and other investment products, and assist clients for financial planning and wealth management. These services help individuals and business make informed investment decisions and grow wealth. Next, trade finance. The commercial banks facilitate domestic and international trade. They offer trade finance services, including issuing letters of credit, providing export-import financing, and offering trade-related services such as trade guarantees and bill discounting. The services enable business to engage in international trade and manage the associated financial risk. Next, risk management. The commercial banks manage various risks associated with their operations. They assess credit worthiness, conduct risk analysis, and implement risk management practices to ensure the soundness of their lending and investment activities. Risk management also includes compliances with regulatory requirements and adherence to prudential norms. Next, other financial services. The commercial banks may offer various other financial services, including insurance products, treasury services, investment banking, merchant banking, financial advisory, and capital market services. The specific services offered can vary depending on the bank and its expertise. It is important to note that commercial banks are subject to regulations and oversight by central banks and regulatory authorities to ensure stability, consumer protection, and compliances with the banking laws and regulations. Next one, central banks. A central bank is a financial institution that acts as a primary authority responsible for overseeing a country's monetary system and ensuring the stability and integrity of the financial system. The functions and responsibilities of a central bank can vary from country to country. It controls the monetary and the banking system of the country. After World War II, the International Monetary Conferences in 1929 recommended setting up a central bank in every country. Next, let us see how economists define the central bank. According to Smith, central banking is a banking system in which a single bank has either complete control or a hereditary monopoly of note issues. Next, according to H.A. Shaw, the central bank is a bank which controls credit. The functions of a central bank vary from country to country, but they typically encompasses the following key roles. First one, monetary policy. This involves managing the money supply, setting interest rates, and influencing credit conditions to achieve price stability, control inflation, and support sustainable economic growth. Next one, currency issuance. Central banks have the authority to issue and regulate the country currency. They oversee the production, distribution, and the integrity of banknotes and coins, ensuring their authenticity and quality. Next one, lender of last resort. Central banks act as lenders of last resort, providing liquidity and emergency funding to banks and financial institutions during financial distress or crisis. They offer short-term loans and credit facilities to stabilize the banking system and maintain confidence in the financial markets. Next one, bank regulation and supervision. Central banks play a crucial role in regulating and supervising commercial banks and other financial institutions. They establish and enforce prudential regulations, to ensure the safety and soundness of the banking system, monitor compliances with the capital adequacy requirements, conduct regular inspections, and address any potential risk or vulnerabilities. Next one, foreign exchange management. Central banks manage a country's foreign exchange reserves, which include holding of foreign currency and other international assets. They intervene in the foreign exchange market to stabilize exchange rates, manage currency fluctuations, and support the balance of payments. Next one, financial stability. The central banks are responsible for maintaining financial stability within the economy. They monitor and assess risk to the overall financial system, implement measures to prevent system risk, and coordinate with other regulatory bodies to address potential threats to the stability of the financial sector. Next one, payment systems and settlements. Central banks oversee and operate payment system, ensuring smooth and secure funds transfers between banks, financial institutions, and individuals. They establish and enforce rules and standards for payment systems and settlements to enhance efficiency, reliability, and security. Next, the economic research and analysis. Central banks conduct economic research analysis data and provide economic forecast and analysis to inform policy decisions. They assess the economic indicators such as inflation, employment, and GDP growth to guide monetary policy formulation and implementation. Next, financial inclusion. The central banks often promote financial inclusion by ensuring that all individuals and business have access to basic financial services. They develop policies and initiatives to expand financial access, enhance financial literacy, and foster inclusion of underserved populations in the formal financial system. Next one, financial stability oversight. The central bank monitor and assess the overall stability of the financial system. They identify and address systematic risk, coordinate with other regulatory bodies to develop macroprudential policies and implement measures to safeguard the stability of the financial sector. Next, Reserve Bank of India norms for banks, RBI norms for banks. At last, we will discuss RBI norms for banks. The Reserve Bank of India is a central bank of India and is responsible for regulating and supervising banks in the country. The Reserve Bank of India established various norms and regulations to ensure the stability, integrity, and the soundness of the banking system. Here are some of the key RBI norms for the banks in India. Capital adequacy norms, prudential norms for asset classification and provisioning, priority sector lending, know your customer norms, anti-money laundering, and cabinating the financing and to terrorism, liquidity norms, corporate governance and risk management, and technology and cyber security. First one, capital adequacy norms. Capital adequacy norms, known as the base third norms, specify the minimum capital requirements that banks must maintain in relation to the risk-weighted asset. These norms aim to enhance the resilience of banks and protect them from financial shocks. Next one, prudential norms for asset classification and provisioning. These norms require banks to classify their assets into different categories based on their quality and to set aside provisions to cover potential losses arising from non-performing assets and other risks. Next one, priority sector lending. RBI mandates that banks allocate a certain percentage of their lending to specified sectors such as agriculture, small-scale industries, education, housing, and micro, small, medium enterprises, This ensures that banks contribute to developing priority sectors and support inclusive growth. Next one, know your customers' norms. The Reserve Bank of India has laid down KYC norms that banks must follow to verify the identify and address of their customers. These norms prevent money laundering, terrorist financing and other illegal activities. Next one, anti-money laundering and financing of terrorism. The banks are required to establish frameworks, implement customer due diligence measures, report suspicious transactions and maintain records as per regulatory requirements. Next one, liquidity norms. The RBI sets liquidity norms to ensure banks maintain sufficient liquidity to meet their obligations and withstand liquidity stress. These norms include the maintenance of the statutory liquidity ratio and liquidity coverage ratio. Next one, corporate governance and risk management. These guidelines cover board composition, risk management framework, internal control, internal audit and disclosure requirements, technology and cyber security. These guidelines cover areas such as cyber security, information security, outsourcing of activities, digital banking and data protection. It is important to note that RBI periodically reviews and updates these norms to align with evaluating market conditions, global best practices and regulatory requirements. Banks must comply with these norms and non-compliances can result in penalties, restrictions or other regulatory actions by the RBI. Thank you very much.